The first question, I mean, we're talking about L1s here, the L1 scorecard. And we'll just open it up with we'll go to you, Sydney. What actually drives L1 decisions from both a building on top of it and also, Zach, more for you, I think we'll get to the investment decision side of it. Is it simply network activity, fees, revenue, developer momentum, user momentum? How do you see it?
Yeah, I think there's a broad approach. Right now, I would say it's liquidity, like which network has the most activity that you can go and capture that liquidity action on. So there ends up, when it comes to being token issuance decisions about putting a protocol on that network, folks are deciding which one has the most landscape and usage to play with. But I would say that also comes down to the scalability, fees, and it really is like a purpose of the network, the accessibility that that network's going to afford, and then the innovations that the networks are leading to.
Yeah, let's go to an investment perspective from Wall Street. What do you think they're looking at, and maybe what should they be looking at that they're not?
Yeah, I'd like to say on this topic, I think it's not as complicated as it sounds. These are, there's economic activity happening on a blockchain, and you can go measure that activity with different indicators and compare those things to prices and valuations. And there's lots of different specific things that you can look at, but the big ones are the number of users, the number of transactions that they are making, and the amount of fees that they are paying with those transactions. And so that's really where we begin with institutional investors, is sort of educate them. There are measurable fundamentals in crypto that can be mapped back to the valuation in prices. And I think it's worth saying at a Solana event that Solana screens very well on all of those types of metrics. When you look at real on-chain data in terms of users, transactions, and fees, Solana typically comes out at the top of the list, and that's one reason that institutional investors are so interested in the technology.
You have anything to add there, Jeff? Anything you disagree with, or anything you really think is not being prioritized?
I agree with both. When people talk about the dreams of crypto, I broadly think there's two experiments that are happening. One is the monetary experiment. That's, of course, Bitcoin, as we've come to know and love. But there's also the technology experiment. And there's aspects to which both of those characteristics require different sets of incentives to actually bootstrap real growth. And that's why I think it's possible to have the ability to appreciate Bitcoin plus Solana in a barbell construct of the two interesting experiments that are happening. And there's no doubt in my mind that Solana has found some fit amongst those who especially care about being technologists, about the things they value to bring developers onto the ecosystem. So as Sydney said, people care about cheapness, they care about speed, and they care about scalability. But the other thing I would add is if you care about just those three things, guess what? TradFi is really good at that too. Citadel, Virtu, Jane Street, you name it. They're good, speed, cheap, and they're scalable. So the reason why we're all here is because we actually care about something a little bit more than those three things. It has some elements to do with capital efficiency, something about censorship resistance. There's aspects of interoperability, and all those things that I think really is why Solana has become a really interesting playground for people to experiment and tinker in.
So we didn't plan this, but that was a great transition. A couple weeks ago at DAS, I feel like every single day things were boiling over with this battle between true DeFi, Canton, permission versus public networks, and blockchains. I'll go to you, Zach. I guess
sure.
I'm sure you have clients who are asking you questions about Canton. We hear it from some Wall Street executives that they like this idea of a permission blockchain. Obviously, we're at a Solana event, so the view is likely to be more on the opposite side of this. But I guess, can you talk about how you view these differences and maybe steelman the Canton side of the argument?
Yeah, we use a sort of slightly different framing than I hear other people use on this topic, and I'm happy to share that perspective. So we think of this basically two types of architectures. There's an institution-centric architecture, and then there's an open architecture. And Canton is an institution-centric architecture. It's kind of like everybody gets their own blockchains, and they can speak to each other over a messaging system of sorts, which is exactly the opposite of how Solana is set up. It's an open architecture, and you can join that network. Now, how does that going to play out, from an investment standpoint? That's the question that we get at Grayscale. And how we tell the story to people is that you need to think about tokenization as playing out over a timeline or a kind of roadmap, and you need to map those architectures to the roadmap. And my maybe slightly controversial take is that over the short term, these institution-centric models will actually see some success because institutions, they want to defend their territory. They don't want to be disintermediated. They want to keep control of their own space. And something like an institution-centric framework, it solves issues like privacy and identity in the same way that they're solved in the traditional financial system by institutions. Now, over time, Solana has a more expansive vision about how the capital markets can change. And I believe that that vision has more value to it over the long run. So I think that Solana will have more work to do into adequately solving privacy and identity for institutional scale capital markets, but ultimately that vision has more value to it. So short term, I think these institutional centric models, I think people should expect them to see some traction. But over time, I think open networks like Solana, you can expect to accrue more value. That's how we are thinking about it at a very high level.
Sydney, do you have anything to
Yeah, no, I think the way that Zach frames it is perfect there. Its purpose for these networks that are privacy-based is for institutional adoption. So we'll start seeing everyone running to the institutional store. We'll start seeing some of that activity that we need to capture on the scalability side that some of the public networks have been iterating on over years, moving to that private space where we can kind of keep the existing frameworks in place and work over time to kind of build a more crypto-centric or Web3 native transaction flow. But as things evolve, the networks that have been building and iterating over years have lots of use cases that maybe are more crypto native. But those are quickly turning into things that Wall Street and institutions care about as well. So I see both of them kind of progressing in similar manners, but we'll start seeing where all the activity is flooding based on how that use case is designed. And there's still privacy-centric features on Solana and other public networks. So lots to be done on both.
Jeff, you have anything you want to
No, I don't think
Okay.
so.
Yeah, I mean, I would guess to you, Zach, I would say, like, at what point does like a private centralized private network become just like more an inefficient database versus like a truly public blockchain? Would be my pushback.
I would say a couple things. First of all, I try to avoid the term private and permission because it's triggering to some audience of some shape or form. So we tend to use institution-centric approaches. I think there are gains to be had in the financial system from moving things onto blockchain rails. There are even more gains to be had by making an open architecture, DeFi, global platform. That's what Solana is trying to do. It's not only just it's not just an efficiency gain about moving information on a blockchain. It's about completely re-architecturing how capital markets work to have all kinds of different products and experiences that we don't have today. And so I think these institution-centric models, you can think of kind of step one down that path. And capital markets have a long way to go. And I think Solana is preparing for that longer-term future. That's how I think about it.
Yeah, this brings up a good question, which is one pushback I hear from very smart people around tokenization is like, securities laws exist for a reason. There are reasons that certain people cannot buy certain securities, the reasons why international persons can't get access to our capital markets necessarily, and like the view and thesis of open decentralized networks is everyone can access them. So I guess like from a legal regulatory framework, like meeting these open permissionless networks, like how do you see this playing out with tokenization and other things along those lines? And particularly the idea that Canton would solve some of those problems, I guess. I'll go to you, Sydney, first.
Yeah, I think on tokenization, we're seeing a lot of new emerging frameworks to capture those real-world assets on-chain. There's a large breadth of real-world assets, and so some real-world assets might better suit for the regulatory nature the public networks, while those permission securities need to have the privacy-centric space. I do think it's all about comfort and accessibility, right? This is a programmable digital technology. We can write in permissions. We can write in different requirements that wallets can have before accessing things. I think it's all about how the networks are going to innovate on what the market's looking for long term. So in that vein, like all the tokenized assets can exist everywhere. It's just who's going to be able to have access to them. A public network doesn't mean you can have access to everything.
Jeff, to you, how important is clarity, I guess, in this space, or versus how much clarity can regulatory agencies like the SEC and CFTC provide on their own without something from Congress?
Look, I think it's super important because it allows crypto investors to finally build the financial rails that people have been wanting to, and it touches upon a lot of things that we already talked about, right? The difference between privacy versus anonymity, and what is that difference as to what institutional adoption can look like. I mean, the thing about like, when you look at this event, Washington x Wall Street, as different as they can be, there's one thing that they're united in about the modern financial system is that they're both engaged in some kind of asset liability manipulation and mismatches, right? The whole business of Wall Street is basically based on some kind of a banking model that is capturing that spread. And Washington too, if you squint hard enough, you realize the whole kind of fractional reserve banking system is oriented around playing that manipulation of time. And so there is actually a shared concurrence for these two interests to meet. And what I think crypto offers is like a third rail solution to that outcome. And tokenization is one of them. But really, instead of just pulling across the vertical axis of manipulating time, how do we actually go the horizontal axis, which is broadening the base? And the things that is unique about crypto, like tokenization, is we're talking about bringing a new TAM of investors that historically may not have been able to access US markets before. So now we're talking about new liquidity that's not just about manipulating time, the young versus the old, but really across a more global geographic footprint that is right for its time in modern finance. And then I would say the z-axis is the velocity of money, right? Because if there's one thing that you can think about as a counter ballast to liquidity manipulation, it's actually a portfolio turnover and how much money velocity can exist. And that's why people are really interested in these kinds of low latency trading where you can have different funding collateral. Because as much as we think about liquidity as being a principle driven by market, so when people think about liquidity, the first thing they think about is, oh, how much is trading in a day? What's the ADV? But really, there is a different kind of liquidity in the financial system, which is funding liquidity, right? The collaterals to which you're able to get more assets to live on top. And the things that crypto is allowing is actually growing that pie in a different slice than just manipulating like the aspect of time alone, which I think is really the innovative financial primitive that is possible in crypto that we're all here for.
All right, Zach, staying on the same sort of topic. We just got news a couple hours ago about the SEC basically sandboxing, allowing certain user interfaces that don't actually take ownership, the self-custody type stuff. They're not going to touch them. There's been a lot of this SEC guidance out of this SEC around like basically allowing things that the crypto industry has been asking for a long time. So I guess one, how much do your clients actually care about those types of things, like your investors that you're talking with, Wall Street? And two, going back to clarity again, we're getting some regulatory clarity, but we're not getting official congressional. So how important is the second part of that versus just SEC guidance?
Yeah. I'd say a couple things about this. One is in some kind of, this is a Washington and Wall Street event, as Jeff was saying, and the regulatory change is important. At some level, I'm not that fussed about this stuff from a short-term standpoint. I really believe that this technology is going to change the financial system, and it's just a matter of time. So we're going to get the rules sorted out over time. We'd all love them to be sooner rather than later, but whether it's this administration or 3 more from now, I'm going to be here for it, and I think we are going to get it sorted out at one level or another. Now, that being said, when you look at the shorter-term stuff, how I think about the Clarity Act, we are seeing movement from the regulatory agencies on some of the same issues. Maybe you could get it done just at an agency level as opposed to by Congress. But I think you immediately reduce a downside tail risk if you pass it through Congress. It's all, investing is about not just one path. It's about the whole distribution of possible outcomes. And there's a possible outcome where you have a different White House that's not as accommodating to the industry. And if you pass bipartisan legislation through Congress and you begin all the rulemaking, you reduce the probability of that outcome affecting markets. So to me, clarity is about reducing downside risk. It's about taking away the possibility that you could have adverse regulatory environment over time. So I think it is very important today in terms of the pricing of these assets, even if the agencies are making some of the same progress.
All right, staying on this theme of tokenization, I guess which networks or L1s are you seeing actually get adoption from a tokenization real-world asset perspective? Is there certain personas you think that are fitting with different chains? What are you seeing?
This is the #1 question I'm asked these days, and I think when you look at the numbers of real-world assets being tokenized on these platforms and the number of holders and volume, this is still very nascent. There's still a lot to be discovered on the persona side of who's using this. Is this a new AUM unlock of the crypto natives looking to hold real-world assets, or are we looking to move the existing players on-chain and they now want to get the benefits of all the mobility and you know, collateral management that you can with these assets as well. Right now, I would say, like with X stocks, since that's launched, that's become hugely successful on Solana and expanding to other networks. And it's mostly giving access to folks outside of the US. So I would say that's the first major use case on the real world asset front. And then we're seeing some additional, you know, tokenized money market funds come up, and that, you know, I think there's been some really great experimentation and development on that front. And again, still kind of iterating. I'd say, you know, to go to Zach and Jeff's points there, like there's development that's going to happen from a regulatory perspective. We're going to hear things about clarity and the SEC. At the same time, we're still iterating on what the technology looks like, and I have a feeling it's going to converge, hopefully later this year, together where there will be a clear framework. We will start seeing adoption and folks onboarded to start using these real-world assets.
To you, Zach, I think a lot of, from what I can see, is a lot of people who are already on chain want some traditional finance or real world assets on chain, and it's less so the TradFi people coming on chain to get access to these things. Do you have any different thoughts on what Sydney said, and when do you think that's going to change?
I would echo all that. Maybe what I would add is just to emphasize how early it is. You know, we can all kind of see the chart of tokenized assets growing, and it looks very encouraging. You know, lots of growth, uncorrelated to the price of Bitcoin. Lots of increasing diversity across products, but to me the most amazing thing is just how small it is. $25 billion is 0.01% or 1 basis point of securities markets, essentially. So you're only just getting this process started. I think that number could plausibly 1,000x in 5 years to $25 trillion number, and even at that level, it'd only be like 10% of the size of equity and bond market. So there are a lot of things happening, but I'm just at a very kind of embryonic stage for the whole process, and I think that's why the main challenge for investors is to try to think about what are the different architectures and how do they accrue value to the asset. You know, how does Solana accommodate this activity, and how does it accrue value back to the token? I think everybody believes this will be a mega trend, and the hardest question is how do you think about investing in something that captures that trend?
Jeff, thoughts?
Yeah, I think your stat on how big the securities market is notable, and it also highlights an undercurrent and undertone of how we're even thinking about tokenization. What I mean by that is every cycle, new narratives emerge in crypto, some pass through, some die. But the thing that I've learned personally in this institutional adoption phase is there's 3 things that are happening. One is we now finally have some clarity around crypto generally being in the confines of commodities than securities. This is something we've asked for a very long time. But if you really think about the business of Wall Street, they're interested in securities, right? They're not the ones that are out there trying to financial engineer commodities historically into products. So that's the first kind of like aperture to appreciate like how we're talking about tokenization and why this is happening first before other things. But make no mistake, crypto, by and large, is going to be a commodities market. That's number one. Number two, I think, is about whether Wall Street was going to eat crypto or whether crypto was going to eat Wall Street and what sequencing was going to allow for the biggest growth in the TAM. And again, I think because this phase right now we're in is so securities-centric in how we talk about tokenization, even though we just decided that most of commodities, tokens are commodities, we're seeing a lot of that product development happen with a securities lens. And the third thing I would mention is there's one thing crypto's been really, really good at from the very beginning, and that's been capital formation and distribution. And what we're seeing is even when you step outside of crypto and just look at Wall Street at large, the growing trend that feels to me irreversible is everybody wants liquidity. Everyone wants public market liquidity earlier, sooner, and at bigger sizes than ever before. That's why we see so many funky things happening in the ETF world that you cover, James, so well, with private companies that are trading at massive NAVs to what they should be, and that being listed. And we're seeing all kinds of funnier things happening in the private market where you have interval funds and tender offer funds and all kinds of weird manipulation about like how do you bring liquidity to things that are fundamentally private and illiquid. And if one thing that crypto is really good at, they figured out how to do capital formation that can bring in new capital for the development of some of these things using crypto rails where that incentive alignment is actually better suited to live within crypto for the things that they're funding. That doesn't look like securities. And so I think within that construct, there's a lot to appreciate about how we're talking about tokenization today versus, to your point, the big TAM. Like what is going to happen after all that? And what is like the long tail of interesting things that are going to develop? And where is it going to happen? And I think it will happen here in Solana in the context of it being driven by a really important kind of technologically driven commodities network.
Sydney, before we move on, you talked about the fact that some of this tokenization stuff is mostly happening for overseas users. Can you talk about, I mean, this kind of goes back to the clarity, regulatory clarity comment, but like, how big is the difference between US versus non-domestic users of these protocols? And do you think that's going to converge at some point? Like, how do you view that regulatory legal framework side of things?
Yeah, I mean, it's really interesting, right? With stablecoins, that was kind of like the first indicator everyone was trying to figure out, like, are these stablecoin transactions happening in the US? Are they happening in South America, in APAC? Like, where can we capture this activity? Right now, I think a lot of the activity is happening where it can't happen. So that has been the kind of fold around of addressing the user base is, folks who need access to this type of, scalability and asset class are moving towards it. And we'll see how that plays out in a regulatory framework. I think there is a lot of, like I said, creative new wrappers around assets that are giving folks exposure. They are very different. They are, should be priced different than equities. They should be looked at in a different framework. We'll see how those get kind of evaluated. Addressing like all the legal classifications by each region is getting to be like an entire full-time job, but we are seeing a lot of progress in how the tokens are actually being used, how the assets are actually being used, and I think that's gonna, almost guide how the regulatory side plays out.
All right, we've been talking about stable coins, tokenization. We're supposed to be talking about L1, so I feel like this is the perfect time to talk about the fact that there's 3 different players trying to launch their own L1 specifically for stablecoins and payments platforms. I guess, Zach, to you, like, what are your thoughts on these L1s? How do you think they're gonna fare in comparison to things like Solana and Ethereum, which are the leaders now?
I think I have to pick up Jeff's comments on this. What do these blockchain networks do well? They do distribution and capital formation, and why do they do that well? Well, they have this global reach. They're open networks that anyone can join. I think that some of these special purpose chains, they may be able to do some things great. Maybe they can, do transactions at an even faster speed than Solana, although it's hard to imagine at some level. But maybe they have some efficiency gains because of the way they're structured. They can do some partnerships. But will they be able to do distribution and capital formation the same way that an open network does? Can it really have the same reach? I don't believe that, basically. So I don't really believe that the corporate chains are a competitor to Solana or to Ethereum or to these other open architecture platforms. I don't see that it's plausible that you could go to every country in the world and get people to trust this network for stablecoin transactions. And whether it's Solana, Ethereum, or even something like a Tron or BNB chain, I mean, part of the reason that they have such reach is they are used all over planet Earth. And I have a hard time believing that a incubated chain by a US company designed for payments in a specific way is going to have that same type of reach.
You were both nodding your head, but Jeff, do you have any
Yeah, no, to augment that, I think like one of the singular chains that may have found some product market fit and success is Hyperliquid. And if you think about what they're doing is they're actually an exchange that happens to use blockchain on the back end, but it's really an exchange business, right? And I think what Zach is saying is actually if you are a blockchain business that happens to be in the business of an exchange, that's actually the future of what hyper-financialization more broadly can look like for other things beyond just trading commodities, right? Because we know Hyperliquid's successful. They've traded more than $5 trillion now since inception, but a lot of the trading is on commodities interests. And if you want to broaden that aperture towards more interesting things, I think the mindset you need to have is rather than an exchange that happens to have a blockchain, you have to be a blockchain that happens to have an exchange-like mindset. And that's where Solana, I think, has like a particularly unique edge because the foundational ethos of that DNA was kind of started with that kind of low latency trading mindset like you would as an exchange operator, but with broader goals to have physical and technical applications beyond just the ledger system behind Wall Street.
Yeah, I would say when thinking of these specific purpose-built layer ones, whether it's for stablecoins or for exchange, it comes down to what I said at the very beginning, like liquidity and where the assets are being held is going to be the biggest kind of bottleneck there. If I'm holding Walmart token and that's on a very specific network and I cannot use that over on Solana where I might be trading something and I have to go through a bridge, like this is just added friction that we were trying to remove from the system to start with. So I think as some of these partnerships that Zach mentioned might come to fruition, the usage base should be kind of dedicated towards what is the most simplest solution and usability here. And so networks that have a lot of purposes built into them, I think will ultimately win out here because I'm not going to hold a bunch of wallets and work with a bunch of bridges that I have to pay a bunch of fees to. That's the same as what exists right now.
Could I add one small thing on this? I'd just like to say that I think open source is an underappreciated piece of this. Hyperliquid is a great product, but that's a closed source product. And open source is you're able to build trust on the foundation of open source because everybody can just look at that themselves. We're in a world where people do not trust each other. And we want to create a platform that anybody in the world can use. And open source software is a way to help do that because they can verify everything themselves. And I think that is a strength of some of these networks that others that have had product success. I think Hyperliquid is a great product, but it is built on closed source, and I think that is a limiting factor for how big that it can grow potentially.
Yeah, just to add one salient example to that is we all love, right now, the meta of prediction markets. It's the big hot thing, and we know that Polymarket's been around a long time. Many of you guys in this room probably know Polymarket runs on Polygon, and that's an Ethereum L2 sidechain. But what you might not know is that they actually do also now run on Solana through an integration with Jupyter. And that kind of thing that just happened 2 months ago can only happen in an open source system. The fact that Polymarket can actually access both chains to go where the customers are and meet them there, where Jupyter is actually intermediating the access point, is the kind of human capital coordination that can really only happen, in my opinion, in an open source framework.
And to add to that, I think when we talk about layer ones and what is the definition of a layer one anyway, is it decentralization? Is it the fact that it is open source and accessible? Is it the fact that things are built on top of it? I don't know, we can debate this ad nauseum, but the concept that there is multiple applications on a single network, I think does open up the breadth there, and the further solutions that can come out of these networks innovating, whether it's how many different developers are working on a network or how these networks are going to progress through this post-quantum era as well, you need to kind of have critical momentum and mass and make sure that this is not just kind of landing on a single point in the fulcrum.
All right, running low on time, but I have 2 more main questions I wanted to get to. So this one's going to be a little more pessimistic for you, Zach. So how much of tokenization and blockchains are going to be like truly reshaping finance versus like swapping out the back end, the plumbing of the traditional financial system, which some people seem to view that as the bull case?
I'm not sure how those things are different. I mean, I guess you're swapping out the back end, and that is changing the system. Maybe a couple of things. I would say, I think the term exports is effective here. Like, crypto has exports, traditional finance, and stable coins, tokenization. I think perpetual futures will be a third major export, traditional finance. And then you will see, things imported from traditional finance into crypto, maybe identity systems, other things, accredited investor rules, all these types of things that we have in traditional financial systems. So I think we are remaking capital markets and merging these two things together, and at the moment they're kind of more importing and exporting to each other as opposed to properly integrating, and maybe we'll be living in that type of environment, and at some point in the future the borders will become blurrier. It'll be harder to tell where crypto ends and where traditional finance begins.
All right, Jeff, we'll start with you on this one. Where's the value going to accrue if you're investing in this space? Is it going to accrue at the app layer or the protocol layer, neither, both, somewhere else? Like, how do you view this from an investment standpoint?
I think this is the trillion-dollar question.
I'm asking for my personal reasons.
Look, I think this is the thing about crypto that is so fascinating. On one hand, because it's attempting to at times be both a financial experiment as well as a technology experiment, it conflates incentives and holders in ways where the patience of that capital to reach its terminal state is challenged. So what I mean by that is like commodities they trade based on flows, right? Like commodities are just where the marginal buyer and sellers meet at a certain point in time, and they think there's some overvaluation that might happen on a technical level, but it is by and large clearing at a certain price. There is no like fundamental anchors about commodities beyond maybe some extrapolation for like inputs to the economy at large. Securities are different because securities have earnings power, they have cash flow, and there's some expectation of profits, and those kinds of things do provide a framework to think about valuation a little bit more thoughtfully. But sometimes in crypto, you're mixing the two things together when there isn't a path for either of them to actually be realizable by the investor community altogether. This, I think, has always been the problem. So one of the reasons I do believe Hype has been successful is because people can see Hype is immensely profitable. They make a lot of money. They have, I think, 11 or 12 employees, and this is your classic crypto alpha. Like if you're Tether or if you're Tron or if you're any, it's the idea of scaling revenue with so little people as possible that if you thought they were distributable to the investors, then it's very valuable. And Hyperliquid never raised venture capital. So it actually never had a cost basis in which people treated it like a securities in which they're thinking about multiples of money. And so I think the sooner we have some structure about what it looks like to establish cost basis for funding innovation, to which you're able to have more transparency around people's cost basis, I think that's step number one. The best thing that could happen for crypto is there's transparency to realize where is everyone coming in at what price, because ultimately that is what tells you what the natural kind of gravity towards liquidity pools are going to be in ways that commodities trade, right? Commodities trade cognizant of that kind of shock externally and internally that can exist. The problem with securities is that's not exactly how it trades, but crypto almost imposes that onto its model. So to make that into a TLDR, look, if you're a profitable protocol and you're making revenue and you have plans to actually distribute that to your end investors in ways that are durable and underwritable, I think that is going to be immensely valuable. There just hasn't been nearly as many experiences at the application level. I think the protocol level is an entirely different kind of way to imagine the TAM, and the one that Zach had alluded to earlier, where the patience we need to see the kind of volume of activities is going to be a little bit longer to then rely on just cash flow alone.
Okay, we're out of time, but Sydney, one last question. You're on a desert island. You can only use one or two on-chain metrics to determine the valuation of a protocol. What are you looking at?
I mean, as Jeff was talking, like MVRV, realized cap, like that's a great way of evaluating when folks have started holding and what price they're comfortable selling at. And I would say economic transfer value.
Okay. All right. Thank you, everyone. That's all we have time for.